macro market trends, stock selection, ETFs, options. Just some of the topics covered in Cook's Kitchen.
Does this market have more downside work to do? I think it probably does, and I've brought some charts to make the case. First, step back to last week. If you watched, we went over 100% long on the FOMC minutes day. In fact, we put our orders in advance of that and ended up 120% long by the end of the week, catching that bounce, looking for a rally back up to resistance. 1675.80 was my target. Well, we got up to 1670, things were looking great, and then all Syria breaks out, and here we are now. Up to that news, I had made a list of my correction watch, my top 10 list for a correction watch of things that we needed to look at that, combined could really weigh on the market. And I was only at a 15 to 20% chance of a big correction because I saw S&P 1635 holding and then the zone down to 1600 also offering strong support. Well, after the Syria news, you add that as number 11 on my top 10 list of things to watch that could work together for a correction. I moved to a 25 to 30% chance of a larger correction that would take out 1600 and probably the June lows at 1560. All right, so we're going to look at the internals of the market, the breadth and some different measures, and see why I think this market still has some more downside work to do. Even if the June lows hold and we don't have a full double-digit correction. All right, first up, this is just a chart of the spiders, and I've thrown exponential moving averages on here. I don't normally use exponential moving averages, but I think right now they give you a good idea of the momentum and the speed of the market, which could pick up speed to the downside. I've got your basic Fibonacci numbers on here, 13, 34, and 55. And you see what happened on Tuesday. The spiders did not actually make that high of 166 here. That was pre-market. But this is a bearish candle here, and we've definitely got some more room to go on the downside. All right, next let's check in with the bullish percent index. This is on the New York Stock Exchange, the NYSE. And remember, this is what we looked at a couple of weeks ago. I showed you Chris Rowe's indicator for a larger top in the stock market when the bullish percent index makes a new high. Stocks haven't yet. Bullish percent index pulls back into a correction. Then stocks go on to make a new high. See, new high stocks. And we've got a lower high in the bullish percent index. Now this is the S&P price chart versus the bullish percent index, but it works the same for our purposes. Anyway, this top calling indicator of Chris Rowe's is obviously on the mark so far. Whether it leads to a much bigger correction, we don't know yet. Let's take a look at some other charts. All right, let's look at the summation index. This is the oscillator that really smooths out advanced decline statistics. Remember, the McClellans developed the McClellan oscillator, which shows you on a daily basis what's going on. And the McClellan oscillator, the NYMO, actually looks very good, making higher lows since the June correction. But the summation index, July gave us a nice rally here, and look what we're doing. We're making a lower low on the summation index, indicating in the aggregate the advanced decline statistics, accumulation and distribution, the big money in the market is becoming net sellers. And so that's what the summation index is telling you. And until this baby turns up, I'm not ready to get aggressively long again. All right, next up, let's look at the percentage of stocks above their 50-day moving average. Again, I'm going to use the New York Stock Exchange, NYA 50. This is on stockcharts.com. You can do all this stuff for free on stockcharts.com, by the way. Great site for doing this stuff. With 867 stocks on the NYSE above their 50-day moving average, that's only 36% of the names because the NYSE has about 2,400 names right now. Now, I'm showing you a 9-month chart just so you can see the, actually a 1-year 9-month chart, so you can see what happened in the 2012 correction. You went below 400 names on the NYSE above their 50-day, the November pullback, and then the June pullback most recently. The thing to note here is, yeah, this is trending down. You see this here from, all this year. I mean, that's not necessarily bearish, because the reason that this is so high, the thing you have to understand about these, when you're either looking at a percentage or a total number of stocks above their 50-day moving average or above their 200-day moving average, when stocks collapse and moving averages are lower, then when the turn happens, it's easy for it to look like, all the issues are above the 200-day moving average, or sometimes above the 50-day moving average. So, it's all relative. It's in relation to what has the major moving average done. And in November, during that pullback, moving averages were trending down and depressed. So it was easy to get this look where you have, over 2,000 stocks above their 50-day moving average in January, and then it's trending down. So I'm not so worried about that trend. What I'm watching is this right here. You look at what happened, last week and early into this week. We got back above 1,200 names in the NYSE above their 50-day moving average, and boom, look how quickly we took that back. Obviously, the index is below it, but now only 36% of big cap stocks, well, not just big caps, but a broad array of the U.S. market, 2,400 stocks below. All right, next, some unique ways of looking at the market here. This is the S&P 1500 Advanced Decline Percent. And this is something from Arthur Hill at stockcharts.com that he sends out to subscribers. This is, obviously in a downtrend here. In this, to him, this chart says stay away, just like the summation index does. So, there's a lot of different ways to look at the internals of the market, the breadth, whether you're looking at percentage of stocks above a certain moving average, or advanced decline statistics, or the McClellan oscillators. This is one new one that we'll start taking a look at. We can also convert this and look at the volume, up-down volume on the S&P 1500. So that's this one here, volume advanced decline percent. And most of these are end of day yesterday. Again, making some new lows here, as the market does, which kind of makes sense, but it probably indicates more downside to come as, we cracked a key level of support for me at S&P 1635. If I had a top 10 list of reasons for a correction that gave buyers a reason to just stand aside and said, hey, it's August, I'm just going to wait and see what happens as we go into debt ceiling negotiations. And can they shut the government down in 33 days on September 30th? You pile that on with everything else, lots of gains on the table, economic weakness, earnings, fair to mixed. Put all that together and you throw the potential of a Mideast conflict in there, you can definitely have a buyer strike. Doesn't mean that institutions are heavily selling, and we didn't see that kind of volume yesterday. It just means when they step aside and they're not in there buying the dips, that short sellers, aggressive hedge funds can take the market down farther. And that's kind of the scenario that you saw in November, after the election, fiscal cliff worries, sort of a buyer strike. And I think you saw the same thing in June. Not heavy institutional selling indicative of a top, but just buyers stepping aside. All right, so we'll check back on some of these indicators next week. Maybe we get a sort of washout low and test 1600 or lower, and these indicators will start to have turned. All right, so that's it for this week, and I look forward to having you join me next week in the kitchen. Thanks.